Welcome, welcome, welcome. If you're listening to this, you are a business owner, an entrepreneur, a manager, or someone who is serious about building something that lasts in Nigeria. And I want to start today with one question, just one that I want you to sit with. Is your business actually making money? Or is it just making noise? Because here is the truth that many people do not want to hear. You can have a beautiful office in Victoria Island. You can have a stunning logo, a professional website, 10 employees, and a business card that impresses everyone. But if revenue is not coming in consistently, growing steadily, and being tracked carefully, none of that matters. None of it. Today we are going to talk about revenue, what it truly is, why it is the most important number in your entire business, how to analyze it properly, who in your organization is responsible for it, and most importantly, how you build systems to make it grow, not by accident, but by design. Get comfortable. This is going to be one of the most important lessons you receive as a Nigerian business owner. Let us begin. Let me start with the definition, and I want to give it to you in the clearest possible way because I have met too many business owners who confuse revenue with profit, and that confusion is costing them millions. Revenue is the total amount of money your business earns from selling its products or services before any expenses are deducted. Revenue is what comes in before anything goes out. It is the top line of your financial statement. It is sometimes called turnover, sales, or gross income. Whatever your accountant calls it, it represents one thing: the total value of what your customers have paid you or have committed to pay you for what you have delivered. Now, let us look at a simple Nigerian example. Imagine you run a catering business in Abuja. In the month of October, you cater for 5 events. You charge 200,000 naira for the first event, 350,000 naira for the second, 180,000 naira for the third, 500,000 naira for the fourth, and 270,000 naira for the fifth. Your total revenue for October is 1,500,000 naira. Now, your rent is 80,000 naira a month. Your food ingredients cost 400,000 naira. You pay your staff 200,000 naira. Your gas, logistics, and other expenses come to 120,000 naira. That is 800,000 naira in total expenses. So your profit for October is 700,000 naira. Revenue 1,500,000 naira. Profit 700,000 naira. They are not the same number. They will never be the same number, and the moment you start treating them as if they are, you are on your way to financial trouble. This is why we always say, revenue is vanity, profit is sanity, but cash flow is reality. Remember that. Now let us talk about why revenue matters, and I mean really matters, beyond the obvious answer of because it pays the bills. First, revenue is the oxygen of your business. Every living thing needs oxygen to survive. Take it away and everything stops. It does not matter how strong or well built the organism is. Revenue is exactly that for your business. Revenue does not just keep the lights on, it keeps the entire enterprise alive. It determines your ability to pay staff, restock, and cover your taxes. Second, revenue validates your business idea. Until a customer pays you money for what you are offering, you do not have a business. You have a hobby, a passion project, or a theory. Revenue is the market telling you, yes, what you are doing has value. We will pay for this. A high engagement on social media without monetizing your skills or creating a sales funnel to generate revenue as a content creator makes your skills a hobby and a great passion. Third, revenue determines your business's capacity to grow. Want to hire more staff? You need revenue. Want to move to a bigger office? Revenue. Want to invest in better equipment, better technology, better marketing? Revenue. If you approach an investor, whether that is a family member with capital or a venture capital firm, they will want to see your revenue trajectory. It is the primary signal of business health and potential. A business with strong growing revenue is a business worth investing in. Fourth, revenue is what investors, banks and partners look at first. If you ever walk into Access Bank, GT Bank or any microfinance institution asking for a business loan, the first question they will ask is, what is your monthly or annual turnover? If you approach an investor, whether that is a family member with capital or a venture capital firm, they will want to see your revenue trajectory. It is the primary signal of business health and potential. A business with strong growing revenue is a business worth investing in. Fifth, revenue gives you negotiating power. When your revenue is strong, you negotiate from a position of strength. With your suppliers, you can demand better pricing because you are buying in volume. With your landlord, you can negotiate a longer lease at a better rate. With your bank, you can get better loan terms. Revenue is not just money, it is power. Now let us move into something that most business owners shy away from, and that is revenue analysis. Many people feel that analyzing numbers is for accountants and finance people. I want to challenge that thinking completely. As a business owner, understanding your revenue is not optional. It is a leadership skill. So what does revenue analysis mean? It means examining your revenue data to understand where your money is coming from, how it is moving, what is driving it, and where the opportunities and risks are hiding. Analysis point 1. Revenue by product or service. If your business offers more than one product or service, and most businesses do, you need to know which ones are generating the most income. I call this your revenue mix. For example, if you run a fashion boutique and you sell ready-to-wear clothing, custom orders and accessories, you need to track revenue for each category separately. You may discover that custom orders represent only 20% of your transactions, but 60% of your revenue. That is critical information. It tells you where to focus your energy, your marketing, and your resources. Analysis point 2. Revenue by time period. Compare your revenue month to month, quarter to quarter, and year to year. Are you growing? Are you declining? Are there seasonal patterns? Knowing that pattern allows you to plan, to save cash in the strong months so you can survive the slow ones without panic. Analysis point 3. Revenue per customer or client. Do you know who your top 5 customers are by revenue? You should. In most businesses, a small number of customers generate a disproportionately large share of revenue. This is sometimes called the 80-20 rule. 80% of your revenue comes from 20% of your customers. Knowing this helps you protect those relationships, serve those clients exceptionally well, and understand the risk if any of them leave. Analysis point 4. Revenue growth rate. Compare this month to the same month last year. If you grew from 2 million naira to 2.6 million naira, your growth rate is 30%. That's healthy. The formula is simple. Revenue growth rate equals current period revenue minus previous period revenue divided by previous period revenue multiplied by 100. Track this number every single month. Do not wait until the end of the year to discover a problem that started in February. Analysis point 5. Revenue versus target. Every business should have a revenue target, a number you are aiming to hit each month, each quarter, each year. And every month, you should measure your actual revenue against that target. If you hit 90% of the target, that is good. But what happened to the other 10%? If you hit 120% of the target, that is excellent. But why did it happen? What can you replicate? Revenue targets without analysis are just wishes, but targets plus analysis become a roadmap. All this analysis can be performed on dashboards in Microsoft Excel, Google Sheets, Power BI, and Tableau. Revenue targets without analysis are just wishes, but targets plus analysis become a roadmap. All these analyses can be performed on dashboards in Microsoft Excel, Google Sheets, Power BI, and Tableau. Let us now look at where revenue lives in your financial statement, because if you are going to talk to your accountant, your investor, or your bank manager intelligently, you need to understand how revenue appears on paper. On the income statement, also called the profit and loss statement, revenue is the very first line. It sits at the top, which is why we call it the top line. Everything else below it is a deduction. Your cost of goods sold comes off it. Your operating expenses come off it. Your taxes come off it. What is left after all those deductions is your net profit, the bottom line. So the income statement tells a story that flows from top to bottom. Revenue, what you earned, minus cost of sales, what it cost you to deliver what you sold, equals gross profit, your first profit checkpoint, minus operating expenses, rent, salaries, utilities, marketing, and so on, equals operating profit, also known as EBIT, earnings before interest and tax, minus interest and tax, your financing costs and your tax obligations to FIRS, equals net profit, what truly belongs to the business after everything. Now, why does this matter to you as a business owner? Because gross profit margin tells you how efficiently you are generating revenue relative to what it costs you to deliver your product or service. If your revenue is 5 million naira and your cost of sales is 3,500,000 naira, your gross profit is 1,500,000 naira, which is a gross margin of 30%. Is 30% good? It depends on your industry. In retail, 20 to 30% is normal. In consulting or professional services, gross margins of 60 to 80% are expected because the cost of delivery is primarily time, not materials. On the balance sheet, revenue does not appear directly, but its cumulative effect does. Consistent, strong revenue builds up your retained earnings, the reserves your business has accumulated over time. Strong retained earnings mean a financially healthy business with the capacity to weather shocks like a sudden economic downturn, a naira devaluation, or an unexpected cost. And on the cash flow statement, you will see the difference between recognized revenue and collected cash. This is critical. In accrual accounting, which is what most former Nigerian businesses use, revenue is recorded when it is earned, not necessarily when cash is received. If you invoice a client in October, but they pay you in December, the revenue appears in October on your income statement, but the cash only appears in December on your cash flow statement. This gap between revenue and cash is where many businesses, including businesses with impressive revenue figures, still run into serious cash flow problems. Never confuse a healthy income statement with a healthy bank account. This is the section that I find most business owners are uncomfortable with because it requires accountability. And accountability can be difficult. But let us have this conversation because it is necessary. Revenue does not generate itself. People generate revenue. And in every well-run organization, there is a clear structure of responsibility for bringing money in the door. Let me walk you through each level. At the top, the business owner and CEO. The ultimate responsibility for revenue rests with the leader of the organization. You set the vision, you approve the pricing strategy, you decide which markets to enter and which to exit. You build the relationships with the biggest clients. You create the culture that either drives a sales-focused revenue-generating team or a complacent reactive one. The sales and business development team. These are the people on the front line of revenue generation. Their only job is to find new customers, convert prospects into paying clients, and grow existing accounts. Every member of this team should have a revenue target, a specific number they are personally accountable for hitting each month. The customer service and relationship management team. Here is something that surprises many business owners. Your customer service team is a revenue team. Why? Because retaining an existing customer costs 5 to 7 times less than acquiring a new one. Every time your customer service team resolves a complaint well, handles a difficult client with grace, or follows up proactively, they are protecting revenue that already exists. In addition, a happy customer refers other customers. Word of mouth is still the most powerful sales tool in Nigeria. Referral revenue that comes from satisfied clients recommending you, is the highest quality revenue a business can have because its acquisition cost is almost zero. The finance and accounting team. Your finance team may not be meeting clients or closing deals, but they play a critical role in revenue health. They ensure that invoices are sent promptly. They track outstanding receivables and follow up on overdue payments. They provide the revenue reports and analysis that allow leadership to make informed decisions. They flag when revenue is falling below target early enough for corrective action. A finance team that is slow to invoice, slow to follow up, and slow to report is quietly damaging your revenue, even if they are doing everything else right. And finally, and this is the mindset shift I want every business to make, every employee in your organization has a role in revenue. The receptionist who greets a client warmly creates the impression that brings that client back. The delivery driver who handles the product with care protects the reputation that wins the next contract. The social media manager who responds to inquiries quickly turns interest into sales. Revenue is not the responsibility of one department. Revenue is everyone's business. How do you grow revenue consistently and by design? Luck runs out. You need a system. Let's look at 7 strategies that work for Nigerian businesses. Strategy 1. Know your numbers and set targets. You cannot grow what you do not measure. Start by establishing a baseline. What is your average monthly revenue for the past 6 months? Now set a target for the next 6 months. Something ambitious but realistic. Break it down by product, by team member, by channel. Review it every single week. What gets measured gets managed. What gets managed gets improved. Strategy 2. Increase prices strategically. Many Nigerian business owners are terrified of raising their prices. They are afraid of losing customers. But here is the reality. If your prices have not increased, while the cost of doing business has gone up because of inflation, naira depreciation, and rising input costs, you are not maintaining your revenue. You are quietly eroding it. Review your pricing at minimum once a year. If you add value, communicate that value, and position yourself correctly. A price increase does not have to mean lost customers. In fact, it can sometimes attract better ones. Strategy 3. Sell more to existing customers. The easiest revenue you will ever generate is from a customer who has already bought from you. They already trust you. They already know your product or service. They need significantly less convincing than a brand new prospect. Ask yourself, what else does my current customer need that I can provide? This is called upselling, offering a more premium version of what they already buy, or cross-selling, offering a complementary product or service. A good accountant recommends tax planning services to a client who initially only asks for bookkeeping. A good caterer offers event decoration to a client who initially only asks for food. Look for these opportunities deliberately. Strategy 4. Acquire new customers systematically. Use social media as an acquisition engine. Every post is a touch point moving a prospect closer to you. Strategy 5. Create recurring revenue streams. One of the most powerful things you can do for your business is to build revenue that comes back automatically every month without you having to go and find it again. For a consulting firm like mine, this looks like retainer arrangements where clients pay a monthly fee for ongoing advisory services rather than paying project by project. For a food business, it might look like a subscription meal plan. For a fashion brand, it might look like a monthly style box. Recurring revenue smooths your cash flow, reduces the pressure of constant selling, and increases the predictable value of your business. Strategy 6. Expand into new markets. Are you currently serving only one city, one segment, one industry? Consider whether expansion makes sense. A business consulting firm that has mastered serving Lagos-based fashion SMEs might find that the same model works perfectly for Abuja-based food businesses with minor adjustments. Market expansion does not have to mean physical expansion. Digital channels allow you to serve clients across Nigeria and even in the diaspora without opening a new office. Revenue that comes from a client in Port Harcourt does not cost you any more than revenue from a client in your own city. Strategy 7. Track, review, and adapt every month without fail. Growth is not a one-time event, it is a discipline. Schedule a monthly revenue review. Sit down with your numbers, your team, and your targets. Ask 3 questions every time. What worked last month that we should do more of? What did not work that we should stop or change? What are we not doing yet that we should start? This simple habit, done consistently every single month, will do more for your revenue growth over 3 years than any single strategy, product launch, or marketing campaign. Let me bring this home for you. Revenue is not just a financial metric. It is a reflection of the value your business is creating in the marketplace. It is a signal of how well you understand your customers, how effectively your team is performing, and how well your systems are working. It is the foundation upon which everything else in your business is built. The business owners who build lasting, profitable enterprises in Nigeria, the ones who scale, who create jobs, who build wealth for their families and their communities, are the ones who take revenue seriously. Not just chasing it blindly, but understanding it deeply, planning for it deliberately, and growing it systematically. Today, I want you to do one thing, just one. Go and find out with precision what your total revenue was for the last 3 months. Break it down by product or service. Identify your top 3 revenue sources and ask yourself honestly, am I growing, stagnating, or declining? That answer is your starting point, and from that starting point, you can build a plan. If you found value in today's session, please share it with a fellow business owner. Leave a comment, ask a question, and subscribe so you do not miss what is coming next. We are building something important here, a community of Nigerian business owners who make decisions based on knowledge, not guesswork. Until next time, keep building, keep learning, and remember, a business that understands its revenue understands its future. Take care of yourselves. I will see you in the next session.